Hi, I'm Mike Richter, and today we're going to be talking about the BRRR strategy in real estate investing. Now, what does BRRR stand for? That's buy, rehab, rent, and refinance. So just to give you a quick overview of what you could expect in this video, we'll be talking about why you might want to use the BRRR strategy, what all is involved in the BRRR strategy as far as some basic objectives. Why is it that we're interested in doing this? We'll also talk briefly about the buy stage, the rehab stage, the rent, and the refinance stages. So let's get started. So the basic objective of the BRRRR strategy is to buy a distressed property just like you would in a flip. And you want to make sure that you have at least 25% equity after all renovations for the refinance. You're renovating it to be in line with both the possibility of reselling it and the possibility of renting it, because depending on your market area and your market circumstances, it might be more advantageous to you to sell it outright, get the cash, and refinance it into another deal, or enroll it into another deal rather, or it might be more advantageous for you to refinance out as much of your equity as possible, usually 75% as of this recording, and take that money and reinvest it while keeping a cash flowing asset that pays you a check every single month. That's a great thing for most people. That's actually something that I like, is the ability to have passive income flowing in. Whereas I'm not a big fan of flipping just because there's tax consequences doing it, and I feel like I would never end up with passive income if I didn't intentionally make that happen. Now, the reason why you would rent it is you're going to rent for a minimum of a year if you ever intend to refinance it or end up selling it. And the reason why is because after 1 year, you can claim the investment property as long-term capital gains as opposed to short-term capital gains, which counts as regular income for tax purposes. I'm not a tax professional, so you'd want to go ahead and consult with your CPA or your tax professional to see how this might affect you in your individual circumstances. So just be aware of that. And the idea also is to refinance as early as possible. As of this recording, it's a 6-month seasoning process with Fannie Mae and Freddie Mac. And you free up 75% of the value of the home so that you can either cash it out and reinvest or pay off your investors if you're using borrowed money for the transaction. So in the buy phase, you want to buy as if you were looking to flip the house. So you're looking for 30 to 35% of after repair value worth of equity there. That way you have space to sell off the property and pay off a realtor a 6% commission, or you're able to use just the equity to help pay for the transaction costs of refinancing later on. You also want to be very conservative in how you underwrite renovations and how you underwrite the value of the property. The reason why is if you end up taking too many liberties with how you evaluate how little a renovation is going to cost and how much you're going to end up having in value, you're bound to end up running into a sticky situation where your numbers don't match up after the renovations happen. And in order to avoid that, that's why we underwrite conservatively. Yes, you will end up getting fewer deals by being conservative in your numbers and sticking to your numbers. However, you are less likely to get bitten in the rear end by having your numbers and your projections not pan out, because there's a lot of times where once you open up a wall, you find something like mold or asbestos that needs to be fixed, and that costs a lot of money that you weren't budgeting in until you opened up a wall. So that's why I would recommend being very conservative in how you underwrite these deals. You want to know your numbers and stick to them in the buying process. Just to give you a recent example, I'm currently in negotiations for a townhome very close to another part of the town that I invest in, and it's a property that's been vacant for 2 years, and the owner is a builder who's owned the property for a while and has let it go vacant for the last 2 years, and he's just looking to sell it off. The house is in very rough condition and needs quite a bit of work. And I know that according to my numbers and my conservative estimates, that I would need to purchase the house at no higher than $52,000 to make it so that I could successfully refinance the property based on the renovations that I'm intending to do to the property. Still in negotiations about it. We'll see how it pans out. He needs 55 as an asking price. I need 52. We'll see how it goes. As far as rehabbing, you want to rehab with both tenants and possible resale in mind. That way you open up the doors to both exit strategies. The reason why you want it with tenants in mind is because you want it to be tenant resistant, so that after a year, if you want to sell the property, you have a much easier time selling the property and you don't have to worry about too much wear and tear on very cost sensitive goods or cheap things that are going to wear out if you've got a less than careful tenant in your property. And something else you want to do the day you close on, or the day you go under contract on the property, is you want to go into the property and go area by area before your inspection and get a preliminary statement of work drawn up. That's where you look at everything that needs to be done in the property and you lay out everything that you're expecting to get done. That way, while you're still in your option period in the purchase, you can get several contractor bids, and if for whatever reason you way underbid your rehab, then you could still get out of the contract at that time and just have to pay off your option fee and not worry about losing your earnest money. Additionally, you want to do it before your inspection just because it buys you that much time to get quotes. And also, you can always adjust your statement of work after the inspection. But you want to get as much of the work done earlier, if at all possible, just because it buys you more time in your option period, which is the best time to negotiate any changes to the sales price or any changes to terms and conditions of the offer. And just to remind you once again, the purpose of this rehab strategy is to open up more possible exit strategies so that you can either rent it out indefinitely and keep that cash flowing asset, or you can sell it off and pocket the cash. So let's talk about the renting piece. Renting makes it really easy to deal with a 6 to 12 month seasoning period on investment properties for a refinance, especially if you're working with borrowed money. As rents come in, it allows you to pay the interest on the loan that you've got with either your hard money lender or your private investor. And at the same time, it ends up building your income so that it helps you qualify better when it comes to the refinance. Renting also allows you to maximize your tax savings, just because you get to depreciate the property and do a lot of things that you would not be able to do if you're just going to flip the house. It also allows you to convert what would be a one-time check in a flip into a steady stream of passive income, and you don't have to worry about your profits being taxed until you sell the property, which is awesome because equity doesn't get taxed, income gets taxed in U.S. tax law at least. And finally, you want to refinance. This is the best part of this strategy because you end up freeing up a lot of your money so that you can keep going and investing in more and more properties. It's a rinse and repeat part of this strategy. As of this recording, you can have up to 10 loans per person based on current lending guidelines. So if both you and your spouse bring home incomes, you can have 10 loans on your name alone, and you can have 10 loans on your wife's name alone, and that works out to 20 loans total. My wife stays at home and she doesn't produce an income that we can track on paper. Of course, she produces value, but it's not something that helps us qualify for additional loans. So in my circumstance, for personal loans, I can only go up to 10. However, for business loans, I can continue going indefinitely, but the terms and conditions associated with those loans are significantly less advantageous than personal loans as far as mortgages are concerned. If you bought and rehabbed the property right, you can pull up to 75% of the property value out as a loan as of this recording. Underwriting guidelines and valuation guidelines can change in the lending industry. That's why I'm letting you know that based on today, you can pull up to 75% of the value of your property out. So just some quick math on how this might work out. So say you buy a house for $50,000, and you know that after you do your renovations, that'll cost you $25,000, that the value that you will have is $100,000. At that point, you can refinance the property, get the $75,000 that you put into the property out. You can pull it out as cash, tax-free, because loans aren't taxed. You can pay off any loans that you've got with personal lenders, with hard money lenders, or with your private lenders. And the result, if you assume a 1% rule for rent, so if you've got a value of $100,000, your rent should be right around $1,000. And say your operating expenses follow the 50% rule, saying that all of your operating expenses, taxes, insurance, property management, repairs, maintenance, all of that is 50% of your gross rent, then we'll take the $380 principal and interest payment associated with the $75,000 mortgage, subtract that from $500, and you end up with a monthly cash flow of $120. So not only did you profit $25,000, but now you've got a paycheck of $125 a month every single month. That's pretty awesome. So not only do you get to continue to invest in real estate, but you now have more mailbox money coming to you. So just to recap, we talked about why do a BRRRR, buy, rehab, rent, and refinance. The basic objective is to build passive income while building a portfolio and being able to pull your cash out without having to deal with some of the tax disadvantages of doing flips. Because if you sell in a period of time less than a year, your proceeds aren't counted as capital gains, they're counted as ordinary income. And most people don't have the business entity structures in place to have it count as anything other than self-employment income. So you end up getting taxed for your full Social Security, Medicare, and Medicaid amount, as well as your marginal tax rate on income. So things to keep in mind as to why we would do a BRRRR instead of a flip. So buying, you want to make sure you're buying right so that you keep the numbers conservative so you don't fall into trouble later on if something comes up that you didn't account for. In your rehab portion, the day you go under contract, you want to go and get a statement of work drawn up so that you can get good, accurate quotes based on the kind of work you're looking to get done at your property from various contractors, assuming you're not going to do the work yourself. I don't have time or the expertise to do the work myself, so I hire it out. You'll also rent out the property so that you can gain an income while you're waiting on the seasoning period for refinancing, and so that once you do refinance, you've got a source of passive income. And speaking of refinancing, the reason why you do is you pull out 75% of your property's value. Hopefully that covers the cash purchase price for the property and your renovation. If so, bam, you get all your money back and you end up with a nice hefty 25% profit plus that passive income every single month. If you liked this video and you found value in it, by all means, go ahead and give it a thumbs up. If you'd like to see more content from this channel, go ahead and hit that subscribe button. And if you'd like to see notifications on new content from this channel, go ahead and hit that little bell symbol once you've subscribed. That way you can change your notification settings on YouTube. Otherwise, YouTube is kind of hit or miss as far as when they provide you subscription updates. And if you've got any questions, comments, or concerns, or you'd like to contribute to the discussion, by all means, go ahead and leave it down in the comments section below. Thank you so much for your time. Make it a great day, and remember one thing: you're only one action away from the rest of your life. Make it count.